Hey everybody, it is that time again for our November net worth update. As a new investor, it can be super scary when the market does its thing and there are corrections, especially when we see our investments take a dip, and not just a little dip, a significant dip. When that happens, I have to remind myself of several things. We're going to talk about those as well as get right into the numbers. Hey, everybody, welcome to our channel. My name is Wendy, and we're so glad you're here. We are all about helping moms and dads on the road to financial independence save more, spend less, and build wealth, but doing it all while living a joy filled life. All right, guys. The market is in the midst of a correction, and it can be super painful to watch as the balances in our accounts go down. And when that happens, there are a few things that I have to remember. The first one is WWJLD, and that is, what would J.L. Collins do? If you haven't read The Simple Path to Wealth, I highly recommend it. It is my absolute most favorite book out there. It was written by J.L. Collins, and we have had the extreme pleasure of meeting with him, hanging out with him, consider him a friend and a mentor. But what was so great about his book is that it's really a no nonsense book on investing and staying the course and letting compound interest and time do its work. If you haven't read the book, I'll put a link down below where you can get a copy of it. The other things that are important to remember is that the market is doing its thing. So we have to just let it do its thing and we stay the course. That money is only lost when we actually sell it. Until then, we still have the same shares. Those shares are going to go up in value. They're going to go down in value. And if we look back at history and the time of the market, it has always gone up. There have been dips here and there in history, but overall, the market has always gone up. So because of that, we have to remember that slow and steady wins the race, and to think of it as a sale. If you're dollar cost averaging like we do, then you're buying stuff on sale. And so that's what we're doing. We're taking a breath. Even though we're seeing those accounts dip, we just continue to add money, and eventually things will go back up. And when that happens, our balances will go up as well, and we'll be in a really great position to see growth. So let's go ahead and take a look at how bad it was. All right. We're going to pull the numbers up on my screen right now. All right. So we're going to take a look at our assets first. We started tracking our net worth in 2017. We started our financial independence journey in 2016. At that time, we had over $1 million in debt, and really we had zero assets. If you can see, back in May of 2017, really the only asset that we had was our house. We no longer have that house, and we'll talk about what we did with that in just a second. But we also had no savings whatsoever. The only thing that we had, and we had just started putting into it the year before, was my husband's retirement. And in May of 2017, that was only at $14,000. Now, last month, you'll see that we no longer have the house. We sold that house a little over 2 years ago, and we did a couple things with that house. It was hard to sell, and it was our dream house, but we decided that it was in our best interest and it made the most financial sense to sell it. We had quite a bit of equity accumulated in it because we bought it as a foreclosure. We had done a lot of improvements to it, and we were able to get quite a bit of money out of it when we sold it. We used that money to do several things. We paid down all of our consumer debt, and then we also used that money as seed money for our investment properties so that we could begin creating cash flow for us and use those houses as part of our overall retirement plan. We have 5 houses in the Midwest area. We're going to have some news about those houses very soon. But we'll save that for another video. Last month, our after-tax investment accounts were close to $32,000. I have a very small IRA that we've started contributing to that was almost at $800. And then Curtis's retirement accounts, that includes both his state pension, he's a teacher, a 403b account, as well as a 457 account. We're not quite yet to maxing out those. We're halfway there. The goal is to eventually max those out entirely. We're very fortunate that he has all three of those vehicles. It's helped us to be able to save more money quickly. All right, so let's take a look at the damage. The value of the rental properties is the same. And like I said, we're going to have an update about that very soon. We think that this number is significantly lower. The housing markets all over the place are going crazy, and that valuation was from last year. So we know that they're worth probably quite a bit more, but we're not going to update those in the spreadsheet yet. All right, so here's where we really took a hit. Our investment accounts were down by about $5,000, and that hurts. So we have the majority of it is in EXP, which is my former real estate brokerage that I was with, and I have some stocks with the company, about 400 shares. Those decreased significantly over the past month. That will eventually go up. I believe in the company. I think their platform is the way that things are going to go. They operate on not a brick and mortar, but they're mostly internet based. So I think that really is the future of real estate brokerages. So I'm not worried. I think that will go up. And then the other decreases that we had were in our cryptocurrencies. Bitcoin has been all over the place. We have a few $1,000s in that. So that has gone down. My retirement account went up a little bit, as well as Kurt's. It helped cushion the blow of some of that loss. But overall, we still had a decrease in our assets of almost $4,000. And that really, really hurts. But again, we know that that will go up. And so we're just going to keep buying. We're going to still keep dollar cost averaging. We're going to put more money in as we have money to do it, and things will look up. So now let's go on to our liabilities. Again, you heard me say that when we started this journey, we were over $1 million in debt, and the bulk of that was our home as well as our student loans. The almost $70,000 were our vehicles and other secured debt that we had. There was credit card debt as well, and I don't know why I've never included that in here, but there was credit card debt in there as well that we paid off. We have an old IRS obligation from when I was in practice with my law office that originally was at over $80,000. And I've talked about before how that happened. When I first went out on my own, we did not have our business set up in the best way to reap tax advantages. We also were very, very bad at estimating our withholding. We had a significant increase in income, and that resulted in higher taxes. So over the years, we have attempted to negotiate and work out plans with the IRS. We finally got that accomplished. And so that balance has gone down quite a bit. As of last month, we were a little over $10,000. Our student loans are staying the same, and that is due to the CARES Act. We have gotten the notification that those are going to begin payments in January. So we are prepared for that. And we might see movement on those. We might not. We have a plan for how these are going to be paid off. My husband is a teacher, so he will be able to take advantage of the PSLF program. And for mine, we are going to slow pay that until they're forgiven, which happens in 20 and 25 years, depending on whether they're undergraduate or graduate degrees. And I have a video about that you can hear why we have opted to do it that way. It is what makes the most financial sense for our family. We have a commercial loan on 4 of our properties, and that's this balance. And then the 5th property, our newest property, is a little over $18,000. You saw an increase from last month, and that has to do with I was estimating the balance. That was simply an update in the balance after I received the statement. The small decrease that we had in our liabilities was due to the small decreases in all of the mortgages on the properties, as well as the IRS debt. So overall, we had a negative change in our net worth for November of $3,172, which was a little sad. I was so happy last month when we saw that our negative net worth was under $100,000. So this month we're back up to over $100,000. But I know that that's going to go down again. And when it does, we'll celebrate again. A new metric that we're tracking is our road to $1 million. And for this, I'm not tracking our overall net worth, but our accumulation of cash and cash equivalents. It took us a little under 5 years to save our first $100,000. And that was in October of last year. So just a little over a year ago. And in just that time, we are almost to $200,000. And that is the miracle of compound interest and saving over time. We're a little over $25,000 away now from reaching $200,000. And that little bit of a hit this month has put us a little farther away from that. But again, I know that that's going to change. And we just have to keep plugging along. Slow and steady wins the race. All right, well, that's all I have for this month, you guys. I hope that you got something out of this video, and remember to just stay the course. Keep dollar cost averaging. Remember that you don't lose money until you sell. Read J.L. Collins's book. And above all, just don't panic. This is the market. This is normal. Everything's going to be okay. Just keep putting your money in there and it will all be all right. All right, guys. Well, we're so glad you're here. And if you haven't subscribed, would you please do that? We have updates all the time and we're always putting out new videos every single week. We'll see you back here again. Take care. Bye.